The following program is intended for listeners who are blind, have low vision, or have another print disability which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at NF. The following program is intended for listeners who are blind, have low vision, or have another print disability which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at nfradioreading.org.
Hello, this is Dasha, and for the next hour, I'll be reading from the Friday, December 19th issue of the Wall Street Journal on the Niagara Frontier Radio Reading Service. The top story on page 1, prices cool, but data incomplete. Shutdown affected collection in the field for the November inflation report by Chow Deng and Matt Grossman. Inflation eased unexpectedly in November, but economists cautioned against reading too much into the report because of gaps in data collection during the long government shutdown. The government's closure made it impossible for Labor Department workers to collect some of the data they normally would have to compile the report on the Consumer Price Index. Even before the release, economists warned that technical workarounds that the agency used to deal with the collection issues may have biased the November figure downward, causing inflation to be understated. The Thursday report, which was released later than normal because of the shutdown, said that consumer prices rose 2.7% in November from a year earlier. That was down from 3% in September and lower than the 3.1% forecast by economists polled by the Wall Street Journal. Treasury yields were relatively steady following the report, but stocks climbed. The Dow gained 0.1% Thursday, while the S&P 500 added 0.8%, and the Nasdaq rose 1.38%. The core measure of prices, which strips out volatile food and energy costs, increased 2.6%. That was also lower than economists' expectations. Officials weren't able to collect prices in the field during the long government shutdown that lasted until November 12th. And there was no October CPI report. Thursday's November report didn't break down month-over-month changes for October and November for most items, and it was hard to draw conclusions about how the economy is faring. I think you just largely put this one to the side, said Alan Detmeister, an economist at investment bank UBS. Maybe this report gives a minor downward sign for overall inflation, but the vast majority of this is just noise and should be ignored. Several analysts said Thursday's report underscored the importance of having reliable and high-quality government data produced by non-political technical statisticians. Doubts about whether that data is properly capturing underlying trends could limit its usefulness for a range of businesses, investors, and government agencies that rely on it. Economists' frustrations with the data marked a difficult end to an annus horribilis for the Bureau of Labor Statistics, the Labor Department's statistics arm. Already grappling with understaffing and tight budgets, the nonpartisan agency was dragged into the political fray in August when President Trump fired its commissioner, saying without evidence that the jobs numbers were rigged to make him look bad. A career official, William Wietrowski, has been serving as acting commissioner since the summer, continuing in the role after Trump withdrew his nominee for the job, E.J. Antony, who had faced criticism over his qualifications and partisanship. A BLS spokeswoman said that its approach conformed with the agency's long-standing plans for handling missing data, consistent with international standards. Federal Reserve officials will have one more inflation report before their next meeting, and that reading is likely to be much more important in helping policymakers calibrate their outlook for inflation. Fed officials have been unusually divided over whether inflation or job market risks should be their greater worry, and they are watching inflation readings carefully to assess how businesses are passing through tariff-related cost increases. Fed Chair Jerome Powell warned last week that Thursday's report could be affected by the shutdown. We're going to look at that really carefully and understand that it may be distorted by very technical factors. Even once data collection resumed, the shutdown forced the BLS to make compromises that impeded the quality of the data, economists who reviewed the numbers said. One of those problems was straightforward, economists said, Black Friday sales. As BLS workers returned to the job, retailers were cutting prices to offer traditional post-Thanksgiving discounts. The BLS uses a seasonal adjustment to correct for that trend, but that seasonal adjustment is designed for a normal November, when workers spend weeks collecting prices before the blockbuster sales begin. An even bigger issue? Missing October data likely made November housing cost increases look milder than they really were. The BLS estimates housing inflation by looking not at a snapshot of current rent levels, but at how rents have changed over previous months, the economist said. The missing data led the BLS's formula to assume that housing prices didn't increase at all in October, a zero that pushed down estimated rent levels in November as well. It's possible that this does reflect a genuine drop-off in inflationary pressures, but such a sudden stop, particularly in the more persistent services components like rent of shelter, is very unusual, at least outside a recession, wrote Capital economist Paul Ashworth. Thursday's data issues aside, tariff policy has largely dominated the conversation around prices this year. Businesses have been passing along some of the costs of Trump's tariffs to customers. Core commodities, excluding food and energy, were up 1.4% over the year, reflecting inflation from tariffs. Tobacco and used cars were among the items that led the way. Rising prices have become a concern for more and more Americans, so much so that discontent over affordability has shaped local elections and forced the Trump administration to re-examine its messaging on the economy. Some companies have already raised prices on consumers as a way to deal with Trump's new tariffs. Others are waiting to see how tariffs settle before raising prices in order not to scare away customers. Economists and investors want to see how inflation prints for January and February, since many businesses adjust their prices at the start of the year. There is a graphic with this showing consumer price index for select items in November, changed from a year earlier. While I'm not going to read the percentages, you can get them if you need to by calling our office. The items that went up in price are coffee, steaks, uncooked beef, audio equipment, motor vehicle repair, utility, piped gas service, household insurance, electricity, hospital and related services, daycare and preschool, eating out, used cars and trucks, shelter, furniture, groceries, major appliances, gasoline, new vehicles, and apparel. Those which went down from a year earlier are car and truck rental, airline fares, other lodging away from home, pork chops, televisions, and eggs. Factory activity slows again in Philadelphia by Don Nico Forbes. Manufacturing activity in the Philadelphia region slipped further into negative territory in December, disappointing expectations of an uptick despite a rise in new orders and shipments. The Federal Reserve Bank of Philadelphia said Thursday that its business activity index for December fell to minus 10.2 from minus 1.7 in November, its third consecutive negative reading. Economists polled by the Wall Street Journal had expected a positive reading of 2. Responses to the December Manufacturing Business Outlook survey suggest weak regional manufacturing activity this month, the survey's authors said. Nearly 28% of firms surveyed reported a fall in activity compared with 18% that saw activity rising, the survey said. The indexes for both new orders and shipments returned to positive territory in December, while the employment index also rose, continuing to reflect increases in employment. And in other U.S. news, the IRS takes a new shot at meta tax strategy by Richard Rubin. The Internal Revenue Service is mounting a novel attack on Meta Platforms' international tax maneuvers, seeking $16 billion in a move that extends and intensifies the decade-long fight between the tech company and the federal government. The IRS says Meta, which owns Facebook and Instagram, booked tens of billions of dollars in profit in Ireland that should have been taxed in the U.S. The company contests that IRS analysis and sued this month in the U.S. tax court. It is Meta's third tax court case since 2016. All stem from 2010 transactions involving an Irish subsidiary. The first lawsuit yielded a split decision this year, with the government winning some legal points and the company largely prevailing on tax calculations. That first case could still get appealed. A second one is pending. This time around, the government is debuting an untested legal argument that has raised alarm bells among tax lawyers and cheered supporters of a more assertive government approach. An IRS win would give the agency a new tool against corporate transactions that shifts profits to low-tax countries, an area where it has struggled. The core issue is how the U.S. taxes income from intangible assets, such as patents, that can be easily moved or licensed across borders. Especially before the U.S. cut tax rates in 2017, companies had incentives to use transactions with subsidiaries to concentrate profits in countries with low tax rates and concentrate deductions in the U.S. In Meta's case, the centerpiece is a 2010 licensing agreement where an Irish subsidiary received the rights to corporate profits outside the U.S. and made payments to the U.S. headquarters. The smaller the payments to the U.S., the bigger the share of global profits that got taxed in Ireland, where tax rates were lower. Until now, the IRS has analyzed internal corporate arrangements by determining what reasonable price should have been when the agreement was made. Officials tried to figure out how unrelated companies might have set deal terms, given all information then available about the future profit possibilities. That is what Meta's first tax court case was about. But critics of that moment-in-time approach argue that there's a fundamental problem. Companies know more than the government does about their businesses and can arrange internal deals to reap outsized, low-tax profits abroad. Advocates for the new IRS approach cite a tax code section that says the government can look at internal transactions and adjust companies' taxes to reflect their true income. In 1986, Congress specified that profits made after transfers or licenses of intangible assets can be allocated so they are commensurate with income. Tax lawyers have spent the subsequent 4 decades debating what that means. It was never really applied because it's such a weird provision, said Michael McDonald, a former U.S. Treasury Department official who recently retired from accounting firm EY. There was enough uncertainty about what it exactly means. To use the law against Meta, the IRS is trying a backward-looking approach known as periodic adjustments, employing Treasury rules that McDonald helped write. Rather than analyzing deals only by examining information known when the internal agreement was made, this new strategy lets the IRS look at what occurred afterward. That means Meta's booming business success during the 2010s, not just its 2010 internal agreement, would be much more relevant to deciding where and how its profits from 2017 to 2019 should be taxed. Stephen Curtis, an economist who runs his own firm, has been urging the government to use periodic adjustments. In articles in the publication Tax Notes, he and others argue that companies, including Meta, could owe a combined $1 trillion if the IRS enforced the law this way. The move against Meta wasn't a complete surprise. Just before President Trump took office, the IRS released a legal memo outlining its thinking on periodic adjustments, previewing a changing strategy that this administration hasn't seemed to alter. The Meta case is the first known deployment of periodic adjustments. An agency spokesman declined to comment. In its lawsuit, the company called the adjustments arbitrary, capricious, or unreasonable. Complex tax litigation moves glacially, and Meta's dispute could take years to resolve. The company argues that the tax court case, where the company largely won on calculations, already resolved issues with the 2010 transactions, and it is also challenging the validity of IRS regulations. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier radio reading service. In world news, ECB holds rates steady as UK cuts, by Paul Hannon and Chelsea Delaney. The Bank of England cut its key interest rate Thursday, while the European Central Bank held steady as a period of more stable borrowing costs sets in across the continent. The UK's central bank reduced its key rate to a near three-year low of 3.75% from 4%, resuming a series of cuts that stretch back to August 2024 after a pause in November. The BOE indicated that borrowing costs are likely to fall over coming months, but are approaching their low. "We still think rates are on a gradual path downward," said BOE Government Andrew Bailey. "But with every cut we make, how much further we go becomes a closer call." The decision was a result of a tight vote, with 4 of the Monetary Policy Committee's 9 members seeking to keep the key rate at 4%. Bailey was the swing voter, having backed to hold in November, but supporting a cut Thursday. Like their counterparts at the Federal Reserve, policymakers are seeking to balance above-target inflation against a cooling jobs market, and MPC members hold differing views about how quickly borrowing costs should fall. In Frankfurt, policymakers opted to hold the deposit rate at 2%, where it has been since June. ECB President Christine Lagarde said Thursday that the ECB is in a good place, repeating a phrase she has used often in recent months. Inflation has fallen back toward the central bank's 2% target and is expected to be under that level next year and in 2027, before returning to around that mark the following year. Growth in the bloc has held up better than expected faced with U.S. tariffs this year. The central bank lifted its forecast Thursday, now projecting the Eurozone economy will expand 1.4% this year and 1.2% in 2026. Lagarde said multiple factors were helping brighten the outlook. Investment in artificial intelligence is driving the economy, as is the continued strength of pharmaceutical exports out of Ireland. Germany's infrastructure and military spending is expected to bolster growth next year. "We think that there is some change taking place in our economies," she said. "What has surprised us on the upside is characteristically investment." Policymakers in Sweden, Norway, and the Czech Republic also kept rates unchanged Thursday. Central banks in Europe are mostly winding down their rate-cutting cycles, with inflation now largely under control. While the ECB is expected to hold rates at 2% all next year, investors expect at least one more BEO cut. The UK's central bank on Thursday said inflation risks are receding, and it now expects price growth to fall closer to its target, which also stands at 2%, in April. In November, the BOE expected annual inflation to reach its target as late as the second quarter of 2027. A story in sports: the furor over World Cup tickets. Global soccer fans learn the expensive realities of the American ticket-buying experience. By Jason Gay. I'd like to begin this column with a good old-fashioned rant. Tickets to major sporting events are too expensive and have been for a long while. I know that might sound heretical in the Wall Street Journal. Ticket pricing usually reflects demand, after all. But the accelerating cost for the average seat to the average major sporting event is annoying, alienating, and perilous to the long-term health of these sports. Professional leagues have made an unbothered short-term choice to chase peak revenue against the clear risk of pricing out their most loyal fans, families, non-corporate buyers, and any number of reasonable people who think it's more than a little bonkers to spend hundreds for unremarkable seats and $14 on a lukewarm lager. Worse, most of these sports have partnered and entangled themselves in the legal secondary market, where price gouging is the expected norm. Fun unintended side effect, blowing out this fluid secondary market has also aggressively raised the chance that a home crowd is embarrassingly invaded out by noisy out-of-town interlopers. Yes, there are always buyers willing to pay a premium for a skybox or courtside seat, and stadiums are loading up on VIP accoutrements to woo big wallets. But attending a sporting event should not be fully converted to a luxury experience. I know it sounds both naive and quaint, but going to see a game should be a common ritual with family and or friends. Think about your own initiation into seeing live sports. Almost surely you remember who took you there. You might remember the atmosphere or some fragrant language. You don't think, "I'll never forget eating a salmon avocado roll in those buttery soft cushioned seats." Alas, the market has been warped. We actually celebrate a four-figure get-in price as a signal of the event's vitality. What was once routine tradition has been upgraded to a rare treat or pushed entirely out of reach. I haven't even gotten to the $60 parking, $175 polyester jerseys, and those $14 beers. If leagues don't think they'll eventually pay for this, they aren't listening to their audience, because when I talk to the most loyal fans and season ticket holders, pricing is all they talk about. Okay, rant over. That was a long way of getting to the World Cup ticket fiasco, which has been both predictable and hilarious. If you're behind, tickets for the upcoming North American World Cup recently went on sale with an escalating pyramid of price categories, which can be summed up thusly: crazy, super crazy, how much money do you think I have, and do you assume I own a plane? FIFA has embraced the common American tactic of dynamic pricing, in which prices fluctuate in response to real-time live demand. Nosebleed seats to less starry games have soared into the hundreds, as good seats at desirable matches crossed into the thousands. $2,735 for the USMNT opener versus Paraguay, if you're feeling plush. The rest of the world erupted. Even jaded fans in the U.S. were astonished to see the cheapest seats for the July 19th final in New Jersey hit $4,185. That's a lot of money to sit with the pigeons in a sterile stadium in the boiling meadowlands and pretend you can see what's going on. Mostly, however, this has been the rest of the planet, wandering into the mad landscape of the American ticket economy and saying, "What fresh hell is this?" And FIFA saying, "This is how it works now." And the rest of the world yelling, "You're going to ruin the sport." And FIFA finally being like, "Okay, maybe we went a little overboard." This week, soccer's poobahs extended a PR-seeking olive branch, a scattering of $60 tickets for all matches, even the final, to be distributed to federations to deliver the value supported. AP reported that 400 to 750 tickets will likely be given to each team, a fraction of the audience at an NFL stadium. I'm going to venture that a $60 seat for the World Cup will be harder to get than a freebie to the Eras Tour, or perhaps even an audience with the Pope. And I haven't gotten to the secondary market where sellers are salivating. On one major outlet I checked, the get-in price for the final is hovering just under $9,000. Again, that's not for a fab seat, that's just to get in. Yes, I know a World Cup has an insatiable demand, and tens of millions are already chasing tickets. And if you think that's evidence of well-set pricing, that's certainly your and FIFA's prerogative. But it's obvious the World Cup is now another sporting event promoting the idea that attendance is some sort of luxe, bucket list feat, instead of a reward or catalyst for lifelong fandom. I haven't even gotten to the extensive cost for travel, hotels, and of course, a delicious daily American breakfast of bacon and donuts. The hazard of a fancy crowd, of course, is that a fancy crowd is a blah crowd, which is standard at a Super Bowl, but lame for a World Cup. The greatest asset of North American extravaganza is the three host nations are so vast that every participating nation can draw a passionate, knowledgeable crowd. Anything that stands in the way of that energy is a mistake. It's the best part of the event. Frankly, it's been inspiring to watch the reaction of fans who aren't accustomed to our absurd marketplace, who aren't already beaten down by the costs and fees, and are calling the organizers out. I applaud them for being noisy enough to effect some modest change. I hope they score a few of those $60 seats. Of course, just wait until they go buy a beer. Then they're really going to lose their minds. Looking at the opinion page, we have one by Joseph Epstein, the author most recently of Never Say You've Had a Lucky Life, whose article is entitled, Donald Trump is a Borax Man. President Trump's recent commercials for Trump wristwatches have caught my attention. In one commercial, 3 watches are shown, each with a red face between the other 2. All 3 have the name Trump on them. Mr. Trump wears the red-faced watch and urges us to buy one, which, along with putting money in his pocket, would show support for him and his movement. I don't know for certain if a president's selling his own merchandise is unprecedented, but it strikes me as extraordinary. A billionaire, he surely doesn't need the money. What I suspect he does need is the action. A real estate man, builder though he has been, he is also a salesman. My guess is that it's through selling, closing the deal, that he gets his true kicks. Mr. Trump seems to me a particular kind of salesman, the kind once known as a Borax Man. In the Chicago of my youth, a Borax Man was an especially slick salesman, aggressive and relentless, usually specializing in home improvement products. These improvements didn't improve anywhere near so thoroughly as the Borax Man promised. The term derives from the white crystalline powder used in cleaning, soldering, glass making, and in pesticides, which in centuries past was sold as a cure-all. Soon it came to mean tawdry and second-class goods. I used to see Borax Men late in the evening at the Black Angus restaurant in my neighborhood. I imagined them recounting stories of the various customers they had succored during the day. The father of a friend of mine who owned a franchise for a company that sold aluminum awnings qualified as a Borax Man. I recall one afternoon visiting his office where a high-stakes poker game was in progress. My father, who started out in life as a salesman and later owned a business, used to refer to my place of business as a nearly sacred place. An afternoon office poker game would have shocked him. Mr. Trump has been called a fascist, an authoritarian, a dictator, and more. None of these terms has seemed to me anywhere near a good fit. All are too elevated. Mr. Trump, not the most learned of men, may never even have heard of some of these words before he was called them. A Borax Man seems a finer, near-perfect fit. As a Borax Man, Donald Trump is attempting to sell the greatest of all products, the promise to return America to its former greatness. Like all Borax Men, he doesn't really deliver the product. His latest Real Clear Politics poll average approval rating on the way he has handled the economy is 41%. But that hasn't stopped him from assuring us that better times under his leadership are on the way, that America will soon be great again. Like the good Borax Man he is, Mr. Trump is always congratulating himself, telling Americans about all the good things he's done for them, with lots more on the way. My father used to say that a salesman first has to sell himself. Mr. Trump attempts to do this, hiring only cabinet members who will flatter him, over and over again telling us of all the wars he's stopped, the economic growth he's caused, the crime he's prevented. Boraxian. I find it helpful to think of our president as a slick and aggressive salesman. His modus operandi generally is better understood when he is so considered. His claims are more easily examined and often necessarily refuted when understood as coming from a high-pressure salesman. Doing so also clears away, at least for me, any remaining aspects of Trump derangement syndrome. I intend to view him as the ultimate Borax Man for the remainder of his time in office, and I invite you to do likewise. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Again, in the opinion pages under Review and Outlook, Trump needs rising real incomes. President Trump assured Americans during his White House speech on Wednesday that happier times will be here again, and we hope he's right. The Labor Department's inflation report on Thursday provided a glimpse of sunshine, although it also underscored why many Americans feel glum. Paychecks are barely keeping pace with rising costs. The Labor Department's Consumer Price Index rose 2.7% over the last 12 months, and overall monthly prices ticked up only 0.2% between September and November. The data is spotty because the government didn't collect prices during the government shutdown in October, but the report suggests that disinflation may be resuming after an inflation surge during the summer. Housing costs and rents are growing at a slower rate as the effects of higher interest rates roll through the market. Travelers are also seeing relief on airfares. negative 5.4% year over year, and hotels, negative 5.7%. Mr. Trump boasted about a decline in egg prices, 13.2% down, but they had been artificially high because of the bird flu. Americans are still seeing price increases on things they regularly consume, including electricity, 6.9%, household furnishings and operations, 4.6%, medical care services, 3.3%, and food, 2.6%. A Fox News poll this week shows that 72% of Americans rate the economy as fair or poor, essentially unchanged from when Mr. Trump entered office. Mr. Trump is right that he inherited the inflation mess from Joe Biden, but Americans don't feel that their situation is improving. Job growth has stalled since the spring, and more important is that incomes after inflation haven't been rising enough. The Bureau of Labor Statistics reported on Thursday that real average hourly earnings for all employees have increased only 0.8% over the last 12 months. That's down from 1.4% 12-month rate a year ago and 1.4% in April before most of his tariffs hit. That's why it's crucial to get inflation down further and faster if Republicans want voters to feel better before the midterm elections. The president is betting on the benefits of his tax bill kicking in next year. Its expensing provisions could lift business investment, and exemptions for tips and overtime and larger state and local tax deductions will increase take-home pay for some. Deregulation is also easing burdens on businesses, which could lead to a boost in hiring and pay. But his tariff barrage is creating uncertainty and adding costs for businesses. Deporting foreign workers without a criminal record is also hampering businesses. According to a state-line analysis of government survey data, restaurants, construction, and landscaping businesses have lost 315,000 foreign workers through August of this year. The administration's trade and immigration policies make it harder to boost housing supply and build new factories, pipelines, and power plants. The Associated General Contractors of America says worker shortages are the top reason for construction delays. Nearly 1 in 3 contractors reports being affected by stepped-up immigration enforcement. J.D. Vance says restricting immigration will raise wages for American workers, but there's little evidence this is happening. Deporting busboys and hotel workers won't make Americans feel richer, nor will Mr. Trump telling voters they've never had it so good. Americans will start to feel better when they get a raise that isn't washed away by inflation. Still in the opinion pages with Political Economics by Joseph Sternberg. The Fed quietly announces it's no longer steering the ship, as President Trump's beauty pageant to select a new Federal Reserve chief grinds on. Spare a thought for the booby prize Jerome Powell has left for his successor. Last week's Federal Open Market Committee meeting dragged the central bank back into quantitative easing. Most attention after the meeting focused on Mr. Powell's interest rate cut, the 6th since September 2024, totaling 1.75 percentage points. But the Fed also announced, via a dry implementation note, that it will buy roughly $40 billion in short-term Treasury bills over the next month, and an indeterminate, but probably similar, monthly amount until at least April. There's reason to believe that if the Fed has started expanding its balance sheet again, it will continue indefinitely. The Fed thinks it is merely fine-tuning a financial system it rewired after the 2008 financial panic. The core issue is the liability side of the central bank's balance sheet and how that changed as a result of the quantitative easing bond purchases that expanded the asset side of the ledger. The Fed, starting after the 2007-2008 crisis, increased its asset holdings by acquiring large quantities of Treasury debt and mortgage-backed securities. These had to be offset by liabilities on the central bank's balance sheet, and the easiest liability to increase was the accounts of reserve funds that commercial banks deposit at the Fed. The central bank created new money with which to buy bonds, and that money flowed into reserve accounts as compensation for the bonds that the Fed had bought from banks and their customers. This practice built a new monetary circuit between the Fed and banks. Commercial banks previously had satisfied their need for liquid reserve assets in a variety of ways, including trading among themselves in an overnight reserves lending market. Following the introduction of quantitative easing, the Fed expected banks to meet their emergency liquidity needs by holding larger reserve balances at the central bank. That expected is deliberately ambiguous. The Fed predicted banks that might prefer the greater safety of reserve balances as a way to satisfy stricter capital adequacy regulations. But officials also put greater pressure on banks to maintain larger reserve balances via regulation and the reward of interest payments on reserve balances. This new ample reserves regime has far-reaching, sometimes hard-to-measure consequences. Because of the way post-2008 financial regulations account for reserves in calculating financial risk, high reserve balances can counterintuitively gum up lending to Main Street and discourage banks from trading treasuries. Now another risk is coming into view: the Fed losing control of its own balance sheet. This problem has emerged as the central bank has embarked on successive attempts at quantitative tightening, shrinking its balance sheet by allowing bonds to run off the asset side of the ledger. Reductions in Fed asset holdings require its liabilities to shrink as well, and this carries the danger that commercial bank reserve deposits may, at some point, fall below the level banks think they need. No one is quite sure where that line is, but if reserve deposits fall below it, interest rates could go haywire in the market for overnight lending, where banks borrow from each other if they need more reserves, shooting far past the target the Fed sets for this, the federal funds rate. This happened in autumn 2019, and officials now seem to be worried by recent similar signs of unrest in that interbank market. Hence their move last week to expand their asset holdings, purchases of treasuries, to avoid a risk that the reserve balance liability might fall too low. The Fed presents all the foregoing as a technocratic matter of little larger importance, but the central bank's resistance to calling it, quote, quantitative easing, end quote, doesn't change the economics of it. The Fed finds itself relaunching a form of QE when it claims it's still in inflation-fighting mode, with all the potential implications for interest rates and inflation that asset purchases bring. This also is an example of how, under an ample reserves system, the central bank's balance sheet must remain large relative to the economy. Apparently, today's level of around 20% is the new minimum. Worse, it's hard to shake the suspicion the Fed is losing control of its balance sheet policy. For most of the post-2008 period, officials decided what quantity of assets they wanted to hold, and then prodded the liability side of the ledger to keep up. Now the central bank is allowing its creditors to steer the ship. Commercial banks can goad the Fed into buying treasuries by increasing their demand for reserves. How else to interpret quantitative easing prompted by the Fed's fear of interbank lending volatility? Alternatives to the ample reserves system exist and will be a topic for another day. Among the candidates for Fed chairman, Kevin Warsh seems keenest to abandon the current regime. Doing so would be a good project for whomever Mr. Trump picks. Delving into the business and finance section now, Elliott considers an IPO for Barnes & Noble by Jeffrey A. Trachtenberg and Ben Dummett. Hedge fund Elliott Investment Management is considering taking bookseller Barnes & Noble and UK book chain Waterstones public, according to people familiar with the matter. The public offering could come as early as the second half of next year, with a potential listing either in London or New York, the people said. Elliott is talking with banks about the idea of an initial public offering, but hasn't chosen an underwriting syndicate, the people said. It also hasn't committed itself to making such an offering next year. The listing would underscore the continued viability of neighborhood bookstores despite the strength of Amazon.com and the increasing popularity of streaming shows and podcasts competing with books for consumers' attention. Elliott bought Barnes & Noble in 2019 in a deal valued at $683 million, including the assumption of debt. At the time, the retailer was struggling to attract shoppers. It reported a loss of $125.5 million on revenue of $3.7 billion for the fiscal year ended April 2018. Same-store sales, a key indicator, were down by more than 5%. Elliott bought Waterstones in 2018 in a deal valued at roughly $279 million. At the time, Waterstones had 238 bookstores, mostly in the UK and Ireland. Both bookstore chains are the largest in their respective countries and have been growing. Barnes & Noble today has 702 stores, including more than 60 that were opened this year, up from 627 when Elliott took over. It also operates 72 paper-source stationery stores. Waterstones has over 290 locations, according to its website. News of the potential public offering was earlier reported by the Financial Times. Both Barnes & Noble and Waterstones are managed by James Daunt, a veteran bookseller who also owns London-based Daunt Books. Daunt set out to remake Barnes & Noble's culture by giving local bookstore managers responsibility for how their stores look and perform, rather than following the traditional chain store approach that valued uniformity. Daunt said in an interview with the Wall Street Journal that 2025 has been a strong year for the U.S. bookstore chain. He also said Barnes & Noble and Waterstones are working closely together. "We are leveraging the respective strengths of the two businesses to improve each," he said. Examples include common training and development, as well as using the same customer service software. The reason Barnes & Noble has rebounded from a very difficult period in just a few years has to do with James Daunt, said Bradley Graham, co-owner of Politics and Prose bookstores in Washington, D.C. He came with a philosophy of letting bookstores reflect their local communities. Graham added that Barnes & Noble has again cut costs and once again represents a competitive threat. "What we want is for Barnes & Noble to be healthy," he said, "but not too aggressive in their expansion." Also from the front page, OpenAI looks to $830 billion valuation by Kate Clark and Burbage. OpenAI is aiming to raise as much as $100 billion as it seeks to pay for ambitious growth plans in a market that has cooled recently on the artificial intelligence boom. The fundraising round, which is in the early stages, could value the company at as much as $830 billion if it raises the full amount it's targeting, people familiar with the matter said. The startup aims to complete the round by the end of the first quarter at the earliest. Terms of the deal still could change, and it is unclear whether there will be sufficient investor demand to reach the goal. The round will present one of the biggest tests the company has faced since the public market's exuberance for AI spending waned. Chief Executive Sam Altman has already scoured the world to build the pool of OpenAI's investors, and the company is now weighing a potential initial public offering, the Wall Street Journal previously reported. OpenAI needs an abundance of capital to build its AI models and stay competitive in a rapidly changing market. SoftBank agreed to invest $30 billion in OpenAI earlier this year and last month sold its NVIDIA stake for $5.8 billion to fund the OpenAI bet. OpenAI is expected to secure the remaining $22.5 billion in planned financing from SoftBank by the end of the year. OpenAI has engaged in a deal-making spree that includes a content licensing agreement and a $1 billion investment from Disney. The deals show that OpenAI's fundraising machine remains formidable, even as questions about how it will pay for expansion remain largely unanswered. OpenAI is expected to recruit sovereign wealth funds to invest in the financing, given the scale, according to people familiar with the matter. The company has previously secured funding from the United Emirates-based MGX. The Information earlier reported some details of OpenAI's latest fundraising efforts. The company has faced skepticism over computing deals it has forged that are worth hundreds of billions of dollars and issued a, quote, code red, end quote, to beat back a growing threat from Google. While OpenAI is set to burn more than $200 billion in cash through 2030, Google has low levels of debt and robust profits, which could make it easier to invest further in AI. News Corp, owner of the journal, has content licensing partnership with OpenAI. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier radio reading service. In Business Watch, the quickies, Rheinmetall venture wins the defense contract. A joint venture, including Rheinmetall, secured a contract valued at roughly 1.7 billion euros, or $2 billion, to supply the German armed forces with space-based reconnaissance data, the latest high-profile order for the defense group. The company said it would partner with ICEYE, a manufacturer and operator of synthetic aperture radar satellites, to set up a joint venture known as Rheinmetall ICEYE Space Solutions that will provide the German armed forces with images via its satellite constellation. The data will mainly be used to protect the German Armed Forces Lithuania Brigade and secure the North Atlantic Treaty Organization's eastern flank at a time when tensions with Russia remain high, Rheinmetall said. Space-based intelligence is the foundational layer of modern defense, but it is no longer just a strategic backdrop. It is a tactical instrument, said Rafal Morzewski, chief executive and co-founder of ICEYE. Production of the first joint venture SAR satellites is scheduled to start in the third quarter of next year, Rheinmetall said. The contract runs to the end of 2030 and can be extended. This was by Mauro Oro. From Alstom, big pact set for Australia Rail Loop. French train maker Alstom said it had won a $5.75 billion contract for Australia's suburban rail loop as part of an alliance that includes other partners. The company said Thursday that the contract for 4.9 billion euros was awarded by the Suburban Rail Loop Authority in Melbourne to the Transit Linux Alliance, which consists of Alstom, John Holland, KBR, WSP, and RATP Development. Alstom's share of the contract work is valued at 1 billion euros, it said. Alstom said its scope of work includes supplying rolling stock, digital infrastructure, signaling and maintenance, as well as handling the overall system integration. Its Dandenong manufacturing site in Australia will assemble and supply 13 automated Metropolis Metro trains, it added. This was by Adria Karatalyud. And from Novo Nordisk, obesity drug maker files for FDA OK. Novo Nordisk filed for U.S. Food and Drug Administration approval of CagriSema, a once-weekly shot that combines two compounds to treat obesity. CagriSema combines the main ingredient in Wegovy with cagrilintide, an experimental drug that mimics a hormone known as amylin that regulates appetite. Early study data of CagriSema late last year disappointed investors with the weight loss it achieved, wiping out nearly $100 billion of the drug maker's stock market value. The trial showed overweight or obese volunteers without type 2 diabetes lost an average of 22.7% of their weight after 68 weeks, falling short of the 25% Novo Nordisk had expected. The Danish drug maker said Thursday that if approved, CagriSema would provide patients and healthcare professionals with an additional treatment option to address unmet medical needs in obesity and support long-term disease management. CagriSema has the potential to represent a meaningful step forward in the holistic treatment of obesity, Chief Executive Mike Dostar said. Its safety profile is comparable with drugs such as Wegovy. The FDA is expected to review the CagriSema application in 2026. Novo Nordisk is currently awaiting FDA approval for its Wegovy weight loss pill, which it expects before year-end. This was by Dominic Chopping. BNP Paribas business in talks to buy Mercedes-Benz arm by Dominic Chopping. BNP Paribas vehicle leasing business is in exclusive talks with Mercedes-Benz to acquire the German automaker's vehicle leasing and fleet management subsidiary. A deal would see Arval's current fleet of 1.9 million vehicles under full-service lease combined with Mercedes-Benz unit Athlon to create an enlarged business with around 2.3 million vehicles. It would expand Arval's presence in key markets and boost its competitive position in Europe. French banking group BNP Paribas said a combination of Arval and Athlon would yield substantial cost synergies and materially enhance efficiency, while contributing nearly 200 million euros, or $234.8 million, to group net income per share in the third year after completion. This transaction is part of BNP Paribas' strategy to develop its profitable platforms in growth markets and to enhance the group's profitability profile through targeted growth levers, the French company said. Completion is expected in 2026, subject to regulatory approvals and consultation with employee representatives. Financial terms weren't disclosed. Looking at Heard on the Street, financial analysis and commentary, Micron results are bad news for tech consumers. The AI gold rush is creating shortages for memory chips that could raise prices for all sorts of gadgets, by Dan Gallagher. If you're wondering why you'll be paying more for a new PC or smartphone next year, Micron's latest financial results provide a big clue. The maker of memory chips posted record revenue and operating income for its fiscal first quarter late Wednesday. Revenue jumped 57% year over year to $13.6 billion. That follows several quarters of strong growth for both metrics. Fueling the growth, demands for artificial intelligence systems that is sharply boosting sales of the specialized type of memory base those products need. And the party seems far from over. Micron projected sales will more than double to a record of $18.7 billion in the current quarter, ending in February, while adjusted operating income will surge more than fivefold to $11.3 billion. Analysts were expecting a strong forecast, given sharply rising memory prices being reported in industry groups and Micron's rivals over the past couple of months. But even they undershot. Micron's revenue forecast beat Wall Street's consensus target by 31%, the highest such beat in at least 5 years, according to FactSet. That explains why a stock that more than doubled in the past year jumped another 10% on Thursday. Rival memory companies SanDisk and Western Digital both picked up more than 5% during the day after the two stocks led the S&P's 500's gainers this year. But while Micron investors are rightfully cheering, the company's report portends challenges in the year ahead for everyone who needs memory chips. That is to say, everyone who uses a PC, smartphone, tablet, game console, or other electronic device. The brains of those devices, generally called central processing chips or CPUs, require memory to function. And there's only so much memory to go around. Soaring demand for AI systems is soaking up more of the available memory supply. That in turn is driving up prices across the board. The spot price of a commonly used module of dynamic random access memory has surged more than 60% in just the past 6 months, according to the market research firm TrendForce. The price is expected to hit $500 next quarter, nearly double the cost in the same period last year. Increasing supply would help tame prices, but like other chip production facilities, memory fabrication plants don't exactly go up overnight. Micron CEO Sanjay Mehrotra noted on Wednesday's earnings call that the company is planning to break ground on a new memory fab in upstate New York early next year. Supply from that fab isn't expected until 2030, though. Micron has other efforts underway to increase production, and the company plans to spend a record $20 billion in the current fiscal year to further that effort. It averaged just over $10 billion in annual capital expenditure over the past 5 years. But the company doesn't even expect that increased level of investment to meet demand for the high bandwidth memory needed for AI. We believe that the aggregate industry supply will remain substantially short of the demand for the foreseeable future, Mehrotra said on the call. Makers of PCs and other affected products are bracing for a hit. We're going to do everything we can to minimize the impact, Dell Chief Operating Officer Jeff Clark said on his company's earnings calls last month. But the fact is, the cost basis is going up across all products. Rival PC maker HP warned investors on its own call last month that higher memory costs would bring the profits down to the low end of their long-term range for the current fiscal year. Some of the memory cost increase will be passed on to consumers in the form of higher prices, and the impact could be noticeable. Earlier this week, Counterpoint Research cut its smartphone shipment forecast for next year to a projected drop of 2.1 in unit sales versus a previous forecast for a slight gain. The timing is particularly bad for makers of high-end phones designed to offer AI capabilities, which require more system memory. Even the kids may feel it. Nintendo's stock price dropped 18% over the past month, which TD Cowen analyst Doug Kreutz attributes mostly to worries about what rising memory prices will do to the company's bottom line. He estimates an additional $40 in memory costs per unit for the Switch 2 console, which would take about 20% off his projected pre-tax earnings for Nintendo's fiscal year ending in March 2027. But he thinks Nintendo might raise the Switch 2 prices by $50 to offset the cost. That wouldn't go down well with Mario fans, but for Micron, the laws of supply and demand are helping it run up a record high score. Look here for mispriced shares. One of the more interesting opportunities in the stock market is easy to miss. Well, it seems like all the attention has been on the S&P 500, and especially AI-related stocks. Some have at least pointed out bargains in the small capitalization companies. Is there something we've overlooked? Yes, everything in between. Mid-caps are like the Jan Brady of the stock market. They lack the size and name recognition of the blue chips, but are no longer as trouble-prone as the small companies. The category is lightly covered by Wall Street analysts, and index funds focused on mid-caps are tiny. That's what we like about it. It provides a lot of opportunities to find mispriced gems, says Andy Romanowicz, a mid-cap fund manager at Madison Funds. The 5 largest companies in the S&P 500 have an average of 66 analysts producing earnings forecasts, according to FactSet. Their counterparts of the S&P 400 average just 15. Some farther down the list have hardly any coverage at all. Similar to small caps, the group has languished over the past 5 years, but mid-cap companies tend to be financially sturdier, and they're nearly as cheap. The S&P 400 trades at 28% discount to the S&P 500 on trailing earnings. Over the past 5 years, the S&P 500 has returned 95% compared with 56% for mid-caps. In the preceding quarter century, though, mid-caps were superb. $1 invested in the S&P 400 grew to be worth more than $15, compared with less than $10 in the S&P 500. Like small caps, the category tends to shine after large company valuations get stretched enough to worry investors, as they have lately. And while a recession or more trade turmoil is at least as dangerous for mid-caps as for large companies, the category looks less risky in other ways. For example, despite having more members, the S&P 500 is surprisingly top-heavy. 13 companies each make up at least 1% of the index. Only one company, the S&P 400, does. The mid-cap index also is less exposed to tech, with about half the S&P 500's industry weighting. The flood of passive money into stock index funds has partially bypassed mid-caps, but there's a silver lining. When a company gets promoted to the S&P 500, it rallies on that news alone because traders anticipate forced buying by the 401k crowd. It's still in the S&P 400 when the gains occur, however. On the other hand, when a company is demoted from the S&P 500, it typically slumps, but is still in that index for several days. Then it enters a mid-cap index at a markdown price. In a market with too much dumb money, it's smart to ask what has been ignored. This by Spencer Jacob. You've been listening to a reading of articles and features from the Friday, December 19th issue of the Wall Street Journal. We read from the Wall Street Journal every Monday through Thursday at 11 p.m. Your reader has been Dasha. Thank you for listening.
Coming up next in the Niagara Frontier Radio Reading Service, we have a reading of the Buffalo Criteria. The following program is intended for listeners who are blind, have low vision, or have another